Welcome everyone to today's budget seminar, and thank you for joining us. Now the dust has settled a little bit and we've had the chance to have a look at the recent events from the announcement last Wednesday. I think it's a good time to sit here, now the dust has settled, just to have a little think and extrapolate what our opinions are on the forthcoming changes. So today we'll be looking at what the changes are, what the implications of these changes and how it may affect clients and introducers, and what clients, introducers and businesses can look to do to mitigate and take advantage of some of these changes. I think it's fair to say, looking back, it's a wee bit of a tax and spend budget. I don't think it's as bad as what some of the rhetoric and what people were thinking previously. I was talking to some clients and introducers last week, and they were saying hopefully there was a little bit of the government putting out some bad news. So when they did introduce some of the changes, everyone said, well, it's not as bad as what we thought it potentially could be. However, with £2.6 trillion worth of debt in the economy, we have to try and find some way of lifting us, excuse me, out of that. And there are only four ways. One, increased taxes, which we'll touch on today. Looking at decreased expenditure, however, some of those reforms of actually increasing some of the welfare spending. Thirdly, look at inflating a way out of it, which Alex will touch on with regards to the markets. And then lastly, looking for a little bit of growth. And I think we were talking just before it started, the government's trying to change some of the behavioural patterns with VCTs, EISs, the change in employee ownership trusts, etc., to try and generate a little bit of growth. Whether that works or not is we'll see in the future. So today we'll be looking at some of the key measures introduced in the budget. We'll be highlighting the financial strength and strategic implications of these changes for individuals, investors and corporates. We'll be looking at how these changes may influence some tax planning, pensions, allowances and overall financial strategies, as well as explore the potential effects of the investment markets, both in the short term and medium term. If I can highlight our panel of guest speakers today, we've got Alex Brandreth, who's been named as Citywise one of the most influential fund selectors. No longer are you one of the young professionals anymore, Alex.
Thanks, a lot of grey hair now.
Okay. We've got Chris Isaac, a chartered financial planner who specialises in working with owner-managed business and accountants. He'll be looking at the financial planning landscape and how the new measures may affect personal financial strategies. And we've got Joe Wan, head of the Employment Benefits Division at Pareto, and he'll be looking at some of the planning considerations that businesses should be thinking about. Together, our speakers will be providing a comprehensive overview designed to help clients. But before we start, just some basic housekeeping. Please can we make sure that we're all in silent to mitigate any of the background noise. The presentation is being recorded and will be available via the usual online streaming platforms. And the presentation should last around about 40 minutes to 45 minutes with Q&As at the end. These can be asked by the Q&A button at the bottom of your Zoom Zoom window. So starting off, everyone, if we could just summarise what we think the relevant points in the budget are for each of our individual areas and how these may affect both individuals, businesses and the market. So Chris, do you want to start?
Yeah, so I think it was described as a smorgasbord, was it, or something? That it was
Smorgasbord.
Yeah, that was kind of, as opposed to kind of big sweeping measures, which we probably saw, last year. There was a lot more probably chipping around the edges and things like that. I think personally, some of the bigger ones, salary sacrifice is certainly one of the big changes. I'll let Joe go into that in more detail, but that will certainly have some implications kind of from 2029. Cash ISAs is the one kind of, catching the headlines at the moment. I think that just seems to be because there's a lot of people with them. That the changes there are really driven around trying to get people to invest more, which I think it is actually the right incentive and the right action to be taking, but how they're kind of implementing it is probably questionable. What they're looking to do is effectively limiting your cash ISA allowance to £12,000 for anyone under 65, but allowing an extra 8,000 that can be in stocks and shares ISAs. So your overall 20,000 is still available, but you're only limited as to how much you can keep in cash. For over 65s, there's effectively no changes. They can still have 20,000 in cash ISAs. As I said, how they're implementing it, there's going to be lots of questions around, well, can you just hold cash funds within a stocks and shares ISA, etc. But reading the detail in the budget, there certainly seems to be some questionable ways that they're going to be policing it, potentially taxing cash interest within ISAs and things like that. So that'll be one to look out for, but I believe that one's not coming until 2027. So I'm sure there'll be some consultations, and then some big ones around kind of, I guess the biggest in terms of bringing in money was the freeze to the personal thresholds. There's not too much that can be done around that in a sense. Effectively, the basic rate, higher rate, and additional rate bands are getting frozen now all the way out, I think, till 2031. It was already frozen since, I think, about 5 or so years, and it was due to keep going for another couple of years, but they've effectively extended that out. Again, there's not too much that can be done there, but it, in a way, kind of probably makes pensions a bit more attractive in the way that you can get some tax relief and income tax relief. So I'll dig into that in a bit more detail a bit later on. And then some changes to dividends tax rates, savings tax rates, and interest. So, they suggested they weren't going to impact working people. So they've, not changed full income tax rates. They've just, again, hit some small targeted areas, but it will certainly have a big impact. So they're adding 2% effectively to the dividends tax rates for the lower two, and 2% on savings and interest as well, and property income as well. So certainly, going to have some pretty wide-ranging implications.
And I think that's important, Chris, with what we were saying before about trying to encourage investors going into the markets, because for owning property now might not be as incentivized as what perhaps it was. Having a lot of money sat in cash might not be as incentivized as what previously it was.
Yeah, I think you can see that the intention behind it,
Yes.
what they're trying to do. I think for properties, for pretty much since about 2017, since they started tweaking tax relief available to buy-to-let investors, there's been a clear strategy there to make property investing less attractive. I'm sure it's not going to completely stop people investing in property. It's certainly still attractive to a lot of people. But yeah, it certainly seems to be trying to encourage people to invest more. And again, looking at dividends, tax rates, and interest, it will be important to look at your options in terms of making sure you're using all your tax wrappers and that your investments are invested tax efficiently, because, effectively they're, lifting up taxes all over the place. So it's making sure that you're certainly making use of your allowance.
Create that fiscal drag.
Yeah.
So Alex, do you mind touching on with regards to how, because the markets have acted quite positively to it, hasn't had a major, in fact, we're up, aren't we?
I think
since Wednesday.
Yeah, so I think if you look at the major markets, the first one to look at is the bond market. You mentioned the amount of debt that we have, and that's clearly very important. And if you go back to 3 years ago in the mini budget, that's what really spooked investors, is that given all these tax cuts and money away, how's the UK going to be able to fund that? And it's clear that Rachel Reeves has come out and said, well, I'm going to raise even more tax, which is reassured the bond market, which is a positive. So you saw a bit of a whipsaw on Wednesday last week. So bond yields have increased initially, but then they've fallen since. So that's a positive, because it means that there's confidence within the bond investors that we can finance and pay for our debt. And if you look at the comments over the weekend, you could argue, has she gone too far? I mean, the OBR have come out and said that the debt that she's has raised has exceeded what she said. So that has created a bit of uncertainty in the market.
She was told that supposedly a couple of weeks ago.
I think it was about 6 weeks ago. Yeah. So it's a long time ago. And then you think about all the posturing that happened up until the budget, with not only will we have this stealth tax of bans being frozen for another 3 years, but is income tax actually going to go up? And then that was rolled back on, but that was all done with the knowledge of what the OBR data was. So that is a bit disappointing to hear that after the event. But anyway, the bond market has been secure. The next thing is, well, what's the impact of the budget to growth and inflation? The impact from last year's budget is clear that it's been inflationary, because you've seen wages go up, you've seen national insurance go up, and the OBR have said that inflation this year is going to run at 3.5%. So we're nearly at the end of the year, so they're going to get that right, aren't they? You'd hope. But as we go into next year, it's more likely to be 2.5%, and then magically it's going to hit the Bank of England's 2% target for the rest of the Parliament. So that's a positive. Inflation's under control, and to be honest, I agree with that in terms of inflation does look like it's peaked, and we've already seen a fall from the last figure from 3.6 to 3.4. We'll probably see another couple of falls, which means that gives the Bank of England room to cut interest rates. So we've got a interest rates decision coming up early December. We'd expect interest rates to be cut again then, and then cut again as we go into next year. So that's again positive for the economy, because that means that more people are going to want to be going out spending. It's not so great if you've got money in the bank, because the return that you're getting from cash is coming down. So that's been another positive for the bond market. The equity market was quite strong last week as well, particularly banks. There was a lot of talk when the run up to the budget about a bank levy coming in, or additional taxes being raised on banks. That never materialised. There was nothing on the oil and gas industry as well. It's actually only really the gambling industry that looks like it's been the major political football during this budget. So they have had a bit of a poorer run. But the overall positive messages come through. Economic growth looks relatively robust next year. Inflation's coming back down to trend, and that's supportive for risk assets. So the equity market's done well, and bonds have done well. So after what had been a bit of a trickier start to November, with all this kind of hype about artificial intelligence coming to an end, and some falls and expensive valuations and bubbles being talked about, it's kind of reassured investors in the short term.
Good. And Joe, just thinking about the impact this is having on some of the business owners who've seen the national minimum wage potentially going up, and then we also heard about salary exchange not being taken away in full, but changing in 2029. So I don't know if you want to touch on the changes there.
Yeah, so sure. Following on the last budget where they increased national insurance contributions for employers, so we saw that go up from 13.8 to 15%. So companies have felt that pain in the past 12 months, and to counteract that, a lot of companies have implemented things like pension salary exchange. I suppose just to be totally clear on pension salary sacrifice, salary exchange, seen a lot of reports online, social media, and the news, and there's kind of a bit of a misconception that this is going to how big of an impact it's going to be. With pensions, when it comes to salary sacrifice, everybody still gets income tax relief, and that is the real attractive element of saving into a pension scheme. So if you want to put £100 into a pension scheme and you're a basic rate taxpayer, that costs you £80. If you're a higher rate taxpayer, that costs you £60. So there's some significant savings there. The tweak they're looking to make isn't happening until 2029.
Yeah.
And even in 2029, it's only impacting people who pay contributions above £2,000. So, and on that element, it's impacting NIC at 8% for basic rate taxpayers, and higher rate taxpayers at 2%. So using my example of £100, your higher rate taxpayers are going to be out of pocket by 2%, which is £2 on £100 contribution you sacrifice, or 8% on your basic rate taxpayer. So it is really hurting the people kind of broadly above 40k to 50k. It doesn't really impact your average person in the UK, because the average salary in the UK is broadly 37k. So someone contributing an average contribution of 5% on that type of salary will be unaffected in 2029. But it's a long way away yet still, so it may not happen. But so just a couple of misconceptions to clear up. Income tax is still available, and that's the real attractiveness of pensions when it comes to company pensions or individual pensions. And the NI element, which comes in 2029, is only on the bit above 2000k, and it's kind of probably not changing the dial too much.
And one of the positive things when we've been discussing, I think people have thought salary exchange maybe been too good for a little bit too long, perhaps a little bit like employee ownership trusts, but at least with them bringing in this £2,000 cap, we think it's going to be here to stay for the long term.
Yeah, absolutely. It's not, I mean, that was the concern. The government look at this every budget, we feel like. And so, yeah, it's very much here for the long term. You've got 3.5 years where full savings will be, you'll be able to capitalise on, and then from 2029 it's just a little bit of a cap on £2,000 that you sacrifice. As I say, it doesn't hit your average employee in the UK. So my message would be to companies, if you're not doing pension salary sacrifice, you absolutely should be. Now in the
Particularly
next
the
3
next 3
months,
years.
but even after in 2029, it's still hugely attractive because there'll be significant savings.
It's almost rubber stamping it as a policy as well from the government as well.
And that's not just in terms of offering it for people that want to do necessarily more than the minimum pension contributions. Am I right in thinking that, actually, if you've just got your standard scheme, you can tweak how that's set up? Because I think, again, that's probably a bit of a misconception when salary sacrifice is, spoken about, that often it's thinking of people who are doing more than what they need to or choosing to do it. But actually, there can be savings for employers, actually just tweaking their workplace scheme. Is that right?
Yeah, I think that, I mean, the savings aren't disappearing. I think that's the key message. Next 3 years is all the same. After that, it's 2020, it's only on the 2000. We have modelled a couple of different scenarios where you've got a company with quite a high average salary and a company with a lower average salary. And if you look at the savings to the company from operating salary sacrifice for pensions on both of those, they're still significant. And the dial isn't moving that much on this 2K cap. Yes, companies may look at alternative contribution structures. So what we've seen in the press, people looking at potentially being no employee contribution to sacrifice. Instead of sacrificing, the company pays the full contribution. So you might need to tweak contracts and employment, that sort of thing. But that also has other impacts that companies need to be careful of. So if you agree to a slight pay decrease for the company, it all becomes a company contribution. What happens to your group life insurance that's based on your salary, maternity pay, redundancy pay? So companies need to be careful with the kind of when they're looking at these things. There is things to look at in the coming 3 years, like your communications, like your contracts, like payroll software, any rules you have around it, communicating to employees, they're going to be asking questions. So there's a lot to kind of look at in the coming 3 years, but the key message, I'll say, pensions is very much still hugely attractive, and it will be beyond 2029.
I think, certainly for individuals who are salary sacrificing, the impact for them versus the employer, it's certainly a bigger hit to employers, I think, in terms of that cost. But certainly for an individual, as Joe touched on, the main driver of building money in pensions is one, that it's saving for the retirement in the first place. It's a tax efficient pot that you can then draw on to spend. So certainly, regardless of the tax incentives, there's a place for them. But then when you add in the fact that you're getting income tax relief, which as Joe already touched on, if you're a higher rate taxpayer, that's 40%. Whatever they do with salary sacrifice, it purely that attraction alone is enough to make them attractive. And when you're looking at the other policies where they're freezing thresholds, if people's incomes keep going up and the thresholds remain frozen, more people are going to end up in paying higher rate tax. More people might go over the 100,000 threshold where you start to lose your personal allowance. So in a way, whether it's salary sacrifice or just pension contributions in general, they're probably even more impactful now than they were pre the budget.
But I think that's the impact on private clients. The impact on business owners, there's going to be a squeeze on margins, isn't there, Chris?
Yeah.
So, and we've got other things such as the employee ownership trust thresholds, which have reduced to 50% with no 10%.
Yeah.
On the first £1 million, we've seen changes to VCTs, we've seen changes to EISs. So I think with private clients, they should be looking at sitting down and reviewing their own finances. But I think business owners should also be sitting down with their business advisors and ourselves to see what these impacts are going to be and how we can, moving forward, mitigate some of these.
Yeah, absolutely. I think, certainly for individual clients, if anything that, certainly this budget, there's been some changes, but certainly I wouldn't say there's, I think there's some positives came out of it. One, there was obviously, again, no changes to the pension lump sum. And this time they kept, the Treasury came out a bit earlier and actually kind of suggested that wouldn't happen. The fact they've obviously tinkered with salary sacrifice, but they've not gone for the income tax relief. Again, does that mean they're not going to do it the next time? You can never say never, but I think there's certainly some positives that there were some big changes last year to pensions and inheritance tax. I think maybe they think now we've implemented that and maybe a change to salary sacrifice, the hope might be they might leave them alone for a bit.
Yeah.
I certainly think this budget, in a sense, has hopefully given a bit more certainty to individual clients that, as I said, there's changes around the edges with cash ISAs and things like that, but there's not been sweeping changes like there was last year. And I think that allows people to now sit down with their advisors, with their accountants, with their tax advisors and say, well, where are we now based on the changes last year, the changes now, and let's start planning and looking forward.
But for business owners planning an exit, we're talking about getting rid of business relief in 2026. not getting rid of it,
Half of it.
half of
Yeah.
it coming down and forming into your estate. Agricultural property relief, again, being halved, and you've got your £1 million threshold, but for spices, that's not transferable. And then
It is now.
it is now.
Yeah.
But it wasn't going to be.
No.
This is a point I'm making. In April 2027, pensions forming part of your estate. So business owners, there is a squeeze for the smaller businesses as opposed to the large PLCs.
Yeah, I think the other side of it, oh, sorry, Chris, was one of the other announcements in the week was minimum wages going up. I think that was a big factor last year and a big cost impact for smaller businesses and hospitality industry where they're more reliant on cheaper members of staff or younger members of staff, sorry. And so that's going to be inflationary as well. And that's already been after the year before when minimum wages went up again. So it just feels like they're going
Retail, leisure industry.
Yeah,
nursing.
when you've got food inflation, which is pretty high, it's just more pressure on that type of industry. So I mean that's again feels like they've maybe been left behind from this budget.
Yeah, I think certainly last year it was pretty explicit. This was against business owners and farmers. There was certainly no hiding the impact. I think this time it's probably been a bit more covert in the sense of the salary sacrifice. The way it was framed was more around the impacts on individuals, but actually it's the businesses who are going to get hit by that added cost. We've obviously got minimum wages spoken about. And then there's elements around, even dividends tax. A lot of business owners will structure their remuneration with a smaller salary and a higher dividends. Again, that's going to get impacted. So certainly I think, as a business owner now, you can't really just set and forget. It used to be if you've got pensions and businesses, there was reliefs in place that meant with very little planning, you could still pass a lot on to the next generation if that's your priority. Now you really have to, I think act the earlier the better and at least consider your options. I think we saw, I think there was probably a bit of hope that maybe the rules brought in last year around for farmers and business owners might get softened a bit. The £1 million limit for business relief and then the discounted rate, maybe would that limit get pushed up a bit higher? It wasn't, but there was a kind of acknowledgement and a tweak around the fact that now that £1 million limit can pass on to spouses. So in a way, I think they're certainly sticking to their guns on that, and maybe will they change it down the line potentially? But certainly for business owners, there's lots of considerations. You touched on employee ownership trusts. That was kind of effectively, and it still is, but it was a way of encouraging employee ownership in terms of moving businesses onto future owners. So instead of selling it potentially to another trade buyer or private equity or something like that, that actually you could pass it on to be employee owned, and there was an incentive to do that. Then it meant there was no immediate capital gains tax, which certainly I think was encouraging a lot of people to go down that route. I think in a way, I've seen some commentary around this over the weekend that it's still attractive because you're getting a 50% rate on CGT. So even at the highest rate, we're still looking at 12%. So relative to the other options, it's still attractive, but maybe it will kind of push out the people that were doing it for the wrong reason. Correct. Around only driven by the tax, because yes, it's nice that you're getting a tax break by doing that, but really you should be doing it for the right reasons. That it's a company that should be employee owned, and it shouldn't just be there so that you can then get your money out and it pass on. So it likely will reduce the number that are happening, but maybe the ones that will be doing it purely for the right reasons and not just for the tax side of it.
Just on that, and AIM was a big one that we talked about in terms of business property relief last year. I think what we haven't discussed is the behavioural change, because we haven't seen a single new AIM portfolio since the changes within the budget last year. And I was speaking to an accountant last week after the budget, and they said they do loads of employee ownership trusts and they don't think they're going to be doing that many going forward.
Yep.
So, I mean, how does that impact the tax measures that the government are putting in as well in terms of trying to square the circle? Because just because you put it in a spreadsheet beforehand and you have this much and I'm going to raise this much, doesn't necessarily mean that it's going to be happening. That's the next big risk from this budget. It's the implementation of it as well. Are they going to be able to raise taxes to the need to cover the finances?
So I think we can see what the government's trying to do, whether they're able to achieve it with the policies. We're all still sat on the fence a little bit.
Yeah.
I think what was noticeable from the budget was Rachel Reeves's use of favouring entrepreneurs and it being quite a supposed one for for enterprise and for startups, and certainly there were some measures there around EISs being expanded in that effectively you can have more of your lifetime as a business. EMI schemes being widened a bit again to kind of encourage the right kind of actions within startup businesses, but that was then in a sense offset slightly by changes to VCTs, which again is kind of a bit later stage, but still early stage companies. The tax relief on that was cut from 30% to 20%. But certainly there's, some steps in the right direction. But it's hard to feel too pleased about those factoring in what happened at the last budget. But certainly I think, as you said at the start, Stuart, it could have been worse. And I think now the hope is that there's a bit more clarity, and maybe the next budget, and I'm sure we will be here again doing the same, but maybe there won't be as much speculation going into it because it hasn't been as bad as a lot of people might have feared.
I think that's the thing. We'd last 4 years, every October, November, and they'd push this back as far as they could. We're all scrambling around, wondering what's going to do and worrying about things because of the level of debt that we've got within the UK. I mean, these things weren't usually as big an event, but they are turning into an annual event. And, you touched on it then in terms of it impacts people's behaviour in the run-up because people don't know what the rules are going to be, so they stop doing things. So that slows economic growth. I suppose the beautiful thing we're in now is at least we've got certainty, and it wasn't as bad as most people feared. I think it's going to be bad. I heard it called the Klarna budget. Buy now, pay later, because we're paying later. We're going to be paying 3-4 years down the line when all our taxes are going up. And who knows? Another government came in, other leaders might change the Labour Party next year. Who knows? And that might reverse again. We might have a new chancellor.
And I think looking forward, when we're talking about the impact, probably over 4 or 5 years, intergenerationally, the impact that this is going to have. People have got to consider where they put the money now, what the impact's going to be in terms of long-term returns. So making sure that, AIM isn't for everyone. VCTs, EISs aren't for everyone because they are up at the higher end of the risk portfolio. So I think going forward, we've got to make sure, one, you review your risk profile, make sure your volatility is correct, and make sure you're with the correct fund manager to take account of that.
I mean, I'd always say that anyway. I mean, it's probably, but it's probably, you're right, it's probably heightened that requirement for people to get good advice. And whether, on the financial planning side and the investment side as well. I mean, for us, we're looking at it and thinking, oh, this is actually quite positive. It's positive for money going into the market. And who knows what changes are going to further come to, because it feels like this is the trajectory now. Trajectory is pro-growth. You can keep saying growth, but it needs to actually appear. Joe's going to know what I'm going to say now. It's not, growth isn't like Beetlejuice. You can't say it 3 times and it appears. But we need to see that, and we need to see more investment. And it feels like it is going that way. It just feels like we're limping there, and we're not sprinting there.
Correct. And Joe, just following on when we're talking about business owners, there is going to be that pressure on profits. I know one of the things that we're talking about, some of the savings in salaries can be significant, but also the cost of hiring people. So the way that you work with some of the HR directors and finance directors on staff attraction and retention is important for making sure the employee benefits are correct for companies.
Yeah, absolutely. And looking at the OBR report, it suggested that only 30% of companies actually do salary sacrifice for pensions.
Which is crazy.
Yeah, and no one's ever had stats around it, but that sounds kind of a little bit low if you ask me. I've always kind of thought 50%. So I would say there's massive opportunity for companies to put in salary sacrifice for pensions specifically. There are other salary sacrificeable things you can do, cycle to work, car schemes, etc. But pensions is by far the most lucrative, and it continues to be. But yeah, if you get your employee benefits right, because we're seeing costs in that go up as well, like private medical since COVID has gone up hugely, life insurance and those sort of things. So getting that right, making sure you're shopping around. We quite often work with companies where we go out and do a health check on it, go out to market, we can get costs down anything from up to 30%. And they can use that savings, reinvest it back into the company to help with this kind of increasing in the NI costs that came through the last budget, and some of the extra costs we've talked about, inflation costs as well.
So, I mean, we know what the changes are, what the problems are going forward, and what we're trying to address, whether we're the jogging there or sprinting there is yet to be seen. But there are opportunities out there for private clients, businesses, and the markets, aren't there? So, Chris, do you want to just talk about what opportunities there are for clients out there?
Yeah, absolutely. I think sometimes it's easy to get caught up in the budget, the narrative, the speculation, and forget that, you know, the reason we're doing this in the first place is about longer term plans, longer term objectives, and we've seen that changes can be brought in that have big implications, but you know, we don't know those until they come. And I think sometimes it's you know, it's taking a step back and saying, well, what is it that we're looking to achieve, and despite the changes, you know, what are now the best opportunities? And that's where having ongoing planning is so key. I think probably, as you said, in the last 5 years, there's been so much speculation around budgets, but there's a reason, because there's been lots of changes. And, you know, you certainly can't set up a plan and leave it for 3 years now, because the chances are is what was set up 3 years ago isn't now suitable. So that ongoing planning, both, you know, with all of your professional advisors is crucial. And I think if you get, you know, the right advice, that there are still opportunities out there. It might be that, you know, for someone who's already got a plan, it's tweaks around the edges. You know, this tax wrapper is now more attractive relative to this one, but we can make changes. Or I think just having that advice, and you know, I think expectations has such an impact on you know, sentiment, and going into the budget, and just the general sentiment around the UK economy isn't particularly positive. I think some of that, from the sounds of it, was certainly manufactured by the Labour government, maybe to make the budget then seem less impactful. But I think sometimes, again, even if things aren't as bad as expected, that's all it sometimes takes. I think, you know, just having a bit more positive sentiment, and as Alex touched on, actually the fundamentals, you know, in terms of economic growth, it could be better, but it could be a lot worse. And same with inflation. And sometimes all it takes is a bit of positive momentum to get things going again. And
I think it's worth, with regards to most of our clients, they're planning for at least the medium, more likely the long term. So someone that's come over 50, approaching retirement, they're probably going to have the money in the markets for the next 20, 30 years. And if you go back the previous 20, 30 years, how much has legislation in the markets changed? That's a time frame going forward. So we need to take that into account.
Yeah, and sometimes it's splitting out, you know, that tax changes in the budget doesn't necessarily have a direct correlation to what happens in the markets. You know, certainly all of our clients aren't just solely invested in the UK market. You know, that's why you have, you know, your eggs in plenty of baskets, that the impact of a budget in the UK isn't going to have it, you know, bring down your whole portfolio. And the other element to it is, you know, I think you've probably got better handle on the figures than I do, but certainly since even Labour elected, you know, if you looked at purely the sentiment and the people's feelings around maybe how that first year and a half has gone, I don't think it'd be positive. But the UK market has broadly done all right. So just because, you know, I know certainly from conversations coming into the budget, you know, there's a lot of feeling around sometimes, oh, well, it's not going to be good, growth is bad, therefore I should be taking all my risk out of it. But as you said, Stuart, it's, you know, we're investing for the long term. We're not investing for 6 months, 12 months.
And I think that's worth, with regards to the webinar that we hold quarterly. One of the things you touch on, Alex, is about making sure time in the market, not timing of the market, making sure you're well diversified, making sure you're looking at the longer term as opposed to reacting to short-term implications.
I think this year's probably been a case in point in regard to that. I mean, if you looked at in April, when the tariffs were announced by Trump, you know, that was a scary couple of weeks for markets, and you know, the S&P was down 10 to 15% in a very short period of time. Other markets were down as well, but maybe not as bad as that. But then what's happened since? You've seen agreement after agreement after agreement, certain industries, things being watered down, and the markets have taken off. So, you know, we talk about diversification. The best performing market in October was Japan. Japan was up over 15% for a month. That's staggering. I mean, they had a new prime minister come in. They've had the trade agreement come through as well with the US. But I know Japan's been the best performing stock market this year. And we've had a decent exposure to Japan for a while because there's this corporate change going in and valuations looked attractive. But outside of that, it's been a very good year for investment markets. So everyone talks about technology and AI. You know, you can't get away from it. Every time I have a meeting nowadays, it's one of the top things on the agenda.
There used to be Bitcoin.
It used to be Bitcoin. That's gone off a little bit the last month or two, correct? But European equities have done well. You go into the beginning of this year, the sentiment towards Europe was terrible. You know, France was in a political nightmare. There was issues in Germany. You know, there's still issues in France. You know, if we want to talk about a budget and problems in political issues, you should really look at France. They're talking about changing pension freedoms and getting rid of bank holidays because of the French finances. But they've had about 3 or 4 prime ministers in the space of a year because they're just very difficult to get these things through for obvious reasons. But I mean, Europe's been has outperformed the US this year, and you wouldn't think that with all the narrative that's come through. China, again, has had a really good year. You go back to the beginning of the year, DeepSeek came onto the market. You know, Chinese technology looks like it's exploding, and you can buy it at half the price than you can in the US.
And it's quality now.
It's quality. In the car industry is probably a great example
Yep.
of that. But, you know, BYD are looking to double the amount of forecourts they have in the UK next year. I mean, it's coming from a low base, but it's still, you know, incredibly exciting and changing that's coming through. And you know, some of the more established players and industries in that market are really suffering, particularly on the continent. So, look, there's pressures everywhere. But regardless of that, I mean, you touched on a few stock markets there. I've had a great year. The UK's done well. I mean, we were very excited around the desk that the FTSE 100 was going to go through 10,000 a couple of weeks ago. It's come off a little bit since then. But you know, it's easily likely that you could see it happen in the short term. It doesn't need to be a big move now to go through that level. And then that, you know, that's a positive thing. That's what goes on the front pages of the BBC as opposed to all the negative headlines that you see. So, and sorry, I'm rambling, but the reason why the FTSE 100 isn't a good barometer for the UK economy is because 75% of the earnings in the FTSE 100 come from outside of the UK. Only 25% is focused on what's going on in the UK. So look, global growth is strong. Global interest rates are coming down. It's a supportive
The
backdrop.
opportunities are there, aren't they?
Absolutely, yeah.
Gilt funds are still relevant to people that are sat on cash in companies.
The tax efficient investment.
Tax efficient investment.
Yeah.
So you spoke on a micro level, on an SME level, Joe. For business owners out there, there's still opportunities to make some savings to help, isn't there?
Yeah, absolutely. The message hasn't changed on that. The savings there, as Alex pointed out earlier, this is almost like an implied, an explicit endorsement of salary sacrifice of pensions. If you're not doing it, you should be. And you should be doing it from 2029. So yeah, still lots of savings to be had.
There's a question on that actually that's come through. Excuse me. Salary exchange. What about where employers' current top up the payment with the ERs, NIC saved on the salary given up?
Yeah.
This will have a significant effect on the final fund value at retirement. 2% plus 15% not going in.
Yeah.
Big impact over 25 years, question mark.
Yeah, so that is kind of one of the perceived negatives of this from 2029. So what they're talking about there is for every 1% your employee contributes, the company will pay back their savings. So the company saves 50% or whatever you contribute. So every 1% you contribute, they save 0.15. So some companies just make that easy. They'll add 0.1 to every 1% you contribute. So if you contribute 5, they'll add an extra 0.5 to that. So they rebate that to the employee. So that extra 0.5% over a 35-year working period isn't insignificant. So unfortunately, that is one of the negative offsets of that, but it will only be on the extra £2,000. So we'll have to model that and look at that. I think companies that do that rebate will need to look at how big that impact is. It's difficult to know at this stage. But yeah, that unfortunately is one of the kind of negatives. My experience of kind of implementing salary sacrifice for companies generally over the last kind of 15 years, certainly after the increase to NI on employers last year, we're not seeing a lot of companies rebate that. It's probably in the minority. So there are some, like that example, paternalistic companies out there that do pay that back, and they will need to kind of rejig their employee benefit offering to kind of cover those savings, whether it's going out and do market reviews on the others, or kind of tweaking it in some way to make savings. But yeah, in the main, most companies retain those savings and use them elsewhere in the business.
Okay. I think with a lot of things that are in the budget, the devil's in the detail, isn't there? So
yeah,
when we're talking about someone, you know, if you're a director shareholder of a business, and you make the £60,000 contribution in lieu of your salary, will that be constituted as salary exchange? So there's still lots of questions that need to be answered, and that's why, hence it's not coming out until 2029, and here the sun shines.
We've certainly seen, you know, with big changes like this, there's always a consultation and there's input from often advisors, from product providers. So, you know, what's been suggested, there will be certainly more detail. But, you know, the example being spoken about, because of the fact that we highlighted that, you know, the biggest thing for employees is actually the income tax saving, that, you know, effectively, even if they were receiving the employer's saving on top of that, you know, it's with a tweak or an adjustment, you can still put yourself in a similar position.
Something's better than nothing, isn't it?
Yeah, absolutely. And I think probably the other kind of misconception around the change is for businesses that, you know, even with a cap, but you know, doing salary exchange versus not doing it is still beneficial.
Of course it is.
Because actually for, you know, even for your higher earners, just because their earnings are over, you know, even £100,000, still for the first effectively 40,000 of that, you're getting the full NI saving. So, you know, even if you had a company with lots of high earners and you think, well, actually they're going to be earning more than what that, you know, so that their contribution will be over the cap, you're still getting the saving on that first bit. So actually, versus doing nothing, you know, despite the changes, you're still going to be putting yourself in a better position as a company.
Yeah. Sorry, we have another question for Chris about cash ISAs. Can you talk about the changes there and what the new allowances and things like that, please?
Yeah, so I briefly mentioned at the start. So there was lots of rumours in the run up to the budget around what might happen with cash ISAs. The main reason being is, you know, the UK as a nation really of savers, not investors. You certainly look compared to the US, where, you know, investing is in their blood, and I think the intention from the government, and it's not only, you know, the Labour government that have been trying to do this. In the Conservatives' last budget, they brought in the British ISA, which was slightly different, but it was scrapped. It never made it, but that had the same intention. It's trying to encourage people to invest more. That one was a bit more specific to try and invest in UK companies. But
you've also got the lifetime ISA.
Yeah,
so there's going to be discussions 2026.
Yeah,
the help to buy ISA that's going to be going. So there's a huge discussion around cash ISAs of some sort. What will they look like going forward?
And that's where, you know, the changes now being proposed are that, you know, previously you had a £20,000 allowance each year for your ISAs, and you could effectively do what you like with it. Now there's kind of additional rules to that if you're putting it into cash ISAs, you're only allowed to use 12 of your 20 to do that. You could still then use your remaining 8 to put in stocks and shares, or if you're already using all of it in stocks and shares, you can continue to do that. So there's no changes. So I think on the grand scheme of things, you know, if anything, it might be an opportunity to sit down and go, well, why were you putting that in a cash ISA in the first place? Does it all need to be in there? If there is a reason for having it in cash, well, you shouldn't really let the tax change drive that. You know, if you've got a house deposit set aside for your house you're purchasing in 6 months, and you were, you know, going to put some more in your cash ISA, it doesn't mean now that you should put that in your stocks and shares ISA just because of the tax changes. It's still all around what is the cash for in the first place. But I think you know, it's probably a good thing to encourage that investment side of it. How they actually implement it is going to be the really interesting thing. The consultation has a few details, but they're quite vague, because as a lot of us were discussing pretty much pre the budget when it was being mooted, is, well, nothing stops you, or in theory, nothing stops people having a stocks and shares ISA, but holding cash within it. So whether that's just pure cash within the platform, or a money market fund, or short dated gilts. So the way that we might phrase it is cash-like, and that's how the government have put it in their policy document or proposal, that they might effectively stop people within stocks and shares ISAs holding cash-like investments. Again, how they implement that is going to be, you know, whether that's they're just not purely not available within the platforms, how they police it for people that have already got, you know, is it on all stocks and shares ISAs, or is it just the new money that's going in? There was rumours, well, not even rumours, there's talk within the document that they may even tax cash interest received within stocks and shares ISAs. But again, that could be interest being received from actually a fixed interest fund as part of a wider growth portfolio. So it's how they do it. I certainly don't think what is being proposed will be what's coming in April 2020.
I mean, the immediate thing that jumps in my head, and we'd have to look into the detail a little bit more, is just buying short-dated gilts where the coupons are so low, maybe that might still be a way of getting around it, where the most of the return is going to be from the price appreciating back to par.
And we're looking at a lot of that for clients who do have cash. Because remember, if you've got cash in the bank, most people will probably be getting about 2%, even within an ISA. Even although you can get the 3.5%, 4%, they'll probably only be getting 2.5%. Inflation you mentioned before, Alex, is currently running at 3%. So in real terms, they're actually losing money, even if it is tax-free.
Yeah.
People sat in cash in the bank outside an ISA who get the 2.5% and then paying tax on top of it. It's a double whammy when you look at real term returns.
Yeah. No, absolutely. Yeah.
The review of all of your finances, and we went from 2008 till 2020 with interest rates being absolutely zero, and then we had the spike, and everyone's going, cash is king. We should go back into cash, but that was for a short-term period only. But back to more realistic how markets work.
Yeah, I think if you want to think about where interest rates are going in the future, 3 seems to be a sensible number. It's not at the 5 level that we had a year or two ago when inflation's at double digit. It's not at 0, which causes people to take on too much leverage because money's free. So money should have a cost of capital associated to it. And then that 3% will be the mean. And then it depends on what's going on in the economy. If the economy is overheating, which it's not at the moment, it's positive, but it's not firing, you'd see interest rates higher. If you have a crisis like you've seen in the past 20 years, we've seemed to be rolling from one to another, then interest rates come down again to stimulate and support the economy. That feels like a much more normal world.
Correct.
I think as well, as you touched on, Stuart, there's, the lifetime ISA is needed to be being removed. Help to Buy is going to expire eventually. There was talk of ISAs need to be simplified. There's these lots of ISAs that don't even get spoken about, innovative finance ISAs. I don't think anyone's ever opened one of those, and now they're bringing in a policy which is actually just complicating things further. But just to highlight a couple of other things that reminded me with the kind of cash interest side of it, there was a big change around state pensions in the sense that obviously the triple lock's been continued, but obviously there was lots of hoo-ha around whether people were going to have to pay tax, and again there's a suggestion that if your state pension is your only income, well then you will not pay tax on that even at the point that it's higher than the personal allowance. But if you have any other earned income, well then that will still get taxed. So again, there's been lots of wider announcements, the child benefit cap being taken away, the mansion tax. So a shameless plug, but we'll have circulated our budget document, I believe.
I've got this here. Should be going out later today.
And if that should be coming out soon. And if you don't receive it, obviously reach out to your advisor. But there's lots of changes going on. But I think the message from me is,
well, I counted up over the weekend. This is how sad I was yesterday. Potentially 28 different tax increases.
Wow.
Or allowances being frozen, so the fiscal drag. 28 different increases. That's what I counted up. So
I think just what I just want to go to a slightly different tact, if I may. I think the other thing, we talked about what's happened, what was surprised, what didn't come in the budget. Spending coming down. I mean, spending is out of control in the UK. We've seen the unemployment rate tick up in the last few months. So we're at 5% unemployment, which is the highest it's been since the pandemic in 2021. So unemployment's coming up. Why is that? I think day one rights was a risk, and we haven't touched on that yet. That was actually extended, or isn't coming in from day one now, but it's going to 6 months. So that should provide some certainty for employees.
Correct. Yeah.
So that's another positive that's come through. So hopefully the employment market can improve, despite the fact that minimum wages are going up. But I do think this is a bit of an error. You look at the amount of people we now have on universal credit is the highest ever been. And I appreciate it's changed in the way it's been called and things like that. But they're the people that are not working, so aren't paying taxes, but then are receiving benefits. And, to me, when you have it at these high levels, and it's a pretty controversial thing to say, but, when you have it at these levels, I think it's just too high and it needs to come down. You need to get these people back. We had a client in the other week, and we was highlighting this. He said, you might as well just get these people to dig holes, because at least then they're being, adding value to society. And there's plenty of people out there that legitimise and I'm not saying get rid of it, but I'm saying I feel the system is being slightly abused at the moment.
And I think we also have to remember, Parliament's only 5 years. So there's only 4 years left
Yeah.
for Labour to do something. So looking at long-term planning, there will possibly be a change in 2029 with regards to the government.
Mm.
So,
Yeah.
so just I'm conscious of time. If we could go around the table just as a summary of what you think clients should be thinking of briefly going forward.
Yeah, so I think similar message to last year that now is a better time than ever to sit down with your professional advisors and just review your overall situation, from the ground up in terms of wills, powers of attorney, really basic housekeeping, and just having a review of and nearly sitting down with yourself to say, well, what are my priorities still? Is it inheritance tax? Is it helping the kids? Is it my own lifestyle? And then that helps to drive the decisions, less around what the tax changes might be. But certainly now we've got more clarity, until next year. Now's no better time than ever than to really just sit down. And actually, I think, it could have been worse is my message. And now it's time to, move forward, and hopefully, there'll be a bit more positive sentiment coming.
I think I'd frame it as, coming into this budget, I could see 3 risks. One was the debt sustainability risk. I think extending the headroom, which we haven't touched on actually, is another positive regard to that. The amount of tax being raised puts that away, and the bond market's reacted positively. The next risk is growth and inflation. Last budget was weak for growth and pro-inflation, and that's a negative. That's stagflation. That's not what you want to see for the UK economy. I think the risk of that happening now are reduced following this budget, because I don't think it was controversial as coming through. So it's just tick 1, tick 2, and then now the third risk is implementation risk, like I mentioned. Last year, some of the big savings that were announced were to do with the winter fuel allowance, and that cost. That's one of the black holes that was created by not being able to get that through Parliament. So, like I said, how do people's behaviour change? And are you going to be able to raise the taxes that you need to be able to not have the same situation happen next year's budget as well? That one is to be confirmed. So at least we've got 2 ticks.
2.5.
2.5 ticks. And look, as I said, the market response has been broadly positive. So, and now we've got certainty. So,
And the markets don't mind bad news; they love good news. It's the uncertainty
Yes,
they don't like,
correct.
both in large mega companies and also the smaller companies, because a lot of our clients, SMEs, are entrepreneurial, and as long as they know what they're up against, they will change how they will adapt how they work to accommodate for the legislation that's out.
Yeah, I think one big positive, speaking to our colleagues around our business and the wider K3 group, is that certainty. It's happened now, so the budget's done and dusted, and we can move forward.
Good.
So transactions, looking at even people thinking about whether they should take their lump sum, tax-free lump sum or not. But yeah, from kind of an employee benefits point of view, I think it's business as usual for the next 3.5 years, and from that point onwards, you have a 2K allowance to use. So use it. So if you're not doing salary exchange for pensions, our recommendation would be to certainly look at that.
And I think the only caveat that I would add in is we haven't really spoke about the impact of some of those large changes from the previous budget, such as BR, agricultural property relief, the impact on pensions forming part of the estate. And we're looking at, with our private clients, a lot of the time, using cash flow to model forward what people's estates are going to be, and using some of the assets in terms of the pensions, perhaps, that will form part of the estate in 2027 to look at paying for policies that might pay that inheritance tax for intergenerational planning, using businesses to take out some cover such as relevant property to protect the family, and then for them to use it however they see fit.
Absolutely. There's lots of options out there. It's just sitting down and reviewing those and putting a plan together.
We've seen quite a few clients that have started to take advantage of that already,
Yeah.
with changing their behaviour in terms of gifting. And excuse me, there wasn't any changes to the gifting rule, were there? Because it was proposed that it was going to be extended from 7 years to 10 years, but that never.
Yeah, and I think certainly the first piece of the puzzle when it comes to intergenerational planning is how much do you need to be able to live for as long as you want to live, and the lifestyle you want to live. And it's tough to answer that question where you've got pots of money but you don't necessarily know what they'll provide. Our starting point, put a cash flow together so you can see exactly what you might need and therefore know what is surplus. And then from that point, there's plenty of options to start getting the surplus amount to the next generation. It's just understanding what are the best ones and what you're most comfortable with. So as I harp on again, it's sitting down and reviewing things and then putting plans together.
I don't think we've opened this many junior ISAs for a long time, so there you go.
Come to work for a living for once.
No, I get the other team to to go. I'll just stick to the investment side.
Well, thank you everyone for joining us today. If there's no other questions, I know we've answered a couple during the seminar. And I thank everyone for joining us, dialing in, the panel of guests and experts today who've given us their insights into the markets. As Chris mentioned before, unapologetically, we'll be sending out the Pareto Matters Budgets magazine. That will be with you. Should be going out later today, early tomorrow, where it highlights the whole gambit of the changes within the budget. I think the key message is quite simple. Chris, you mentioned it a number of times, plan proactively. Stay informed by speaking regularly with your financial advisor and sit down and make sure that your long-term plans aren't affected by any short-term changes. If anyone would like any help or advice, please reach out to your advisor, anyone around this table. If you can't get hold of anyone or you wish to ask someone with regards to the markets, especially Alex. And thank you again for attending, and we look forward to seeing you next year. I think we're going to be doing a webinar early next year to see what the implications are.
We'll do a 2026 Outlook one in January, looking ahead to what's coming in the year, and not to give away too much, but you've got local elections in May, you've got the midterm elections in the US in November next year, and look, we'll see where we are. It's been a good year for markets this year. Can that continue?
Hopefully. So 1st of December, I hate wishing everyone a Merry Christmas this early, but I'll...
At least it's December.
At least it's December.
Kids were happy this morning with the advent calendar.
But thank you everyone for joining us.